Hi, I'm Donna Alexander again, and this is Senior Moments. Today, we're going to talk about a rather controversial subject. It's not gun control. It's a little less exciting than that, but it is reverse mortgages. And I know to some people that sounds a little boring, but to the audiences that I speak with, when you talk about reverse mortgages, I typically get very emotionally charged responses. So I wanted us to look at it today and just see what the facts are and see how they work, and let me explain what I know about reverse mortgages and see if maybe that's an option for you. So first of all, they've been around a while. They were first introduced in 1961 as a way to help a new widow stay in her home. So that's almost 60 years ago. And if you think about it, we were just talking about phones a minute ago. Look at how much has changed just with a telephone in the last almost 60 years. So if those can change so drastically from, I remember party lines when I was a kid at my grandmother's house, to now having everybody having their own cell phone. You can watch a TV show or do whatever you want to on a cell phone. That much change in 60 years, surely a reverse mortgage that started out 60 years ago can also change to the better. So it was started in 1961, but it's gone through lots of regulations and lots of legislative changes so that today it's one of the most reliable and dependable investment tools available. Okay, it is insured by the Federal Housing Authority. Okay, that's FHA. That's where we get our mortgages from, and so FHA's been around a while. In 2001, AARP and HUD got together and did some training and some testing to make sure that people who take out the reverse mortgages are aware of what they're doing. And now that counseling is a required piece of the pie to get a reverse mortgage. And in 2009, the reverse mortgage for purchase was first introduced. And that's a neat new concept where you can use a reverse mortgage to buy a new house and not have a payment, but still have a new house. So that's a pretty cool deal. So let's back up a little bit and talk about what is a reverse mortgage. Well, it's a mortgage product. Let me say this. There's more than one reverse mortgage. Most of them that we talk about are the government-backed FHA reverse mortgages. There are others that can be done by private banks and proprietary funds, things like that. But a reverse mortgage is a mortgage product that is designed to help older homeowners tap into the equity that they have in their home. You know, some of my senior clients have been in their home 20, 30, 40 years. And there's a lot of equity there. And they may not necessarily want to sell their house in order to cash in on that. And so this gives them an opportunity to stay in the house, but still get those proceeds. So some of the rules, some of the requirements: borrowers must be at least 62 years old. They must have what they call significant equity in their home, and they must pass a financial assessment. They must also successfully complete that counseling training that I talked about earlier from the AARP and HUD. So let's unpack that. That's a new word I've noticed all the trainers are using. Let's unpack it. So borrowers must be 62 or older. So you can stay in your home as long as you want to. They will not make you leave your home as long as you meet the requirements of the reverse mortgage. The mortgage must be repaid within 1 year of the last borrower leaving the home. So if you have a couple and one passes away or moves to a nursing home or something, the other one can stay there, and as long as they're there, everything is fine. When the second one leaves, when the last borrower leaves the home, then you have a year to pay that loan back. Typically what happens is the family, either the homeowner or the family, will sell the home and pay back the reverse mortgage within that year, and everything works out great. Now you can have one borrower that's 62, and if they have a younger spouse, then they can have a non-borrowing spouse that's younger than that. Now the non-borrowing spouse also is awarded the opportunity to stay in the home even if the borrower passes away. They may not get all the benefits of the reverse mortgage, but they do get to stay in the home. Okay, so the next thing is the significant equity. You must have significant equity in your home because the amount you can borrow is based on your age. It's a percentage based on your age, and that dollar amount has to be enough to cover whatever existing mortgage you may already have on the home. And then whatever's left, you get to put in your pocket. And of course, if you don't have a mortgage, you get to put it all in your pocket. So that's a good thing. The next thing is you must pass a financial assessment. Now, this is where things kind of got a little hairy early on because sometimes things weren't getting paid. You don't have to pay a reverse mortgage. You don't have a monthly payment on a reverse mortgage. But you are required to maintain your taxes, your insurance, any HOA fees or neighborhood fees, and you are required to keep the house maintained. So early on, what was happening is people were either unaware they needed to do that, or they didn't have the ability to do that. So now they've put this financial assessment piece in there to make sure that you have the financial ability to pay those things. And then they've also made sure that you understand that that has to be done. That's part of the counseling thing. And so I think that does make it a lot safer investment for everybody. It makes it a lot easier, and it makes it, then when the family goes to sell the house, they sell the house for whatever they can. They pay back the reverse mortgage and there's nothing left. If those taxes and insurance don't get paid, there's a lien against the house, and the house can't be sold until that lien is paid. And I think that was the problem that people had early on with reverse mortgages. So, and then of course the last piece is to complete that counseling call. And it's usually about a 20 or 30 minute call. It's with a third party vendor. So, okay, so how does a reverse mortgage work? Well, I've already told you the loan amount is based on a percent of the equity in your home based on your age, the current interest rates, the market conditions, and there is an FHA limit of $765,000 or the appraised value of your home, whatever is less. So mine is not $765,000. But anyway, so it is based on your age, the current interest rates, and the market condition. Okay, you do have to have an appraisal, so they'll come out and appraise, and that's how they determine those figures. The money can be drawn out either in one lump sum, or it can be drawn out as monthly payments or some other periodic payment, semi-annually or something like that. So that way you can have the money when you need it. And you can do anything you want to with these funds. You can pay repairs, you can pay for home care assistance, you can take a trip, you can put it in your savings account, you can do whatever you want to with the money. It is yours. It is the equity in your home. And so you don't have any monthly payments with this. So you get rid of your old payments, and then you can have these monthly payments coming in. So it's a pretty good swing for you. It does pay off your first mortgage. The reverse mortgage pays off your first mortgage, and then you can choose to get those monthly payments. So it does make it a little easier to have a better quality of life. You know, a lot of people use it for medications, or, you know, just the cost of living has changed, and your income has probably changed also. So it does help with that. The borrowers or their heirs will never owe more than the market value of the house, and that is an important piece. It's called a non-recourse loan, and that means that the lender has no recourse to get any more than what the house is worth, and that is the piece that makes this so cool. FHA ensures that the lender will be paid the difference between the market value and whatever may be owed against it. So if it doesn't sell for as much as they thought it would, FHA steps in and pays the difference to the lender. The other really good thing about the FHA part of this is that if you're getting monthly or some kind of periodic payments like an annuity type thing, and the bank or the lender goes bad for whatever reason, if they're unable to make those payments to you, FHA steps in and makes those payments to you. So that is a very good thing. You are guaranteed your money. They are guaranteed their money. So that does make everyone feel nice and safe and secure. You cannot be foreclosed on. You cannot be foreclosed on except for not paying your taxes, your insurance, or your HOA fees. These can be liens against the property, and your lender can file foreclosure if these do not get paid. So that is a very important piece that you always need to remember. So you may not have a house payment, but you still have to keep those up, and that can be done monthly or quarterly, annually, however you want to do it. So now, the other thing I hear about a lot are the fees. Everyone says, well, it's very expensive. And yes, it is a chunk. It is an expense, but you pay the fees up front with a reverse mortgage. And those fees then, if you're using it for several years, they kind of allocated through the time that you're taking advantage of it, and the fees aren't really that bad. So there are origination fees. It's capped at $6,000. Typically, it's 2% of the loan amount. There are some real estate closing costs, just like if you buy a house. There's the appraisals, there's surveys, there's title searches, inspections, and there can be some other things. And those are paid to a third party. Those can all be paid out of the proceeds of the loan, so you don't have to pay them out of your pocket initially, but you will be taking home a little bit less money. But if you look at it in terms of how long are you going to have this loan, then it's not so staggering, and it can be a really good deal for you. There's also mortgage interest payments, if it's that pays for the FHA insurance that you're getting. So there's an initial payment for that, but then there's also a little bit of annual payments on that also. So that's kind of the gist of reverse mortgages. They can be a very useful tool. It can be a very good way to tap into your equity and stay put in your home. It can help you take care of repairs or upgrades or bills or everyday life, or it can help you just have a better quality of life. But the last piece I want to talk about is really a very cool thing. It's called the reverse mortgage for purchase. And the way this works is you can buy a house with a lump sum. So typically what happens is people have an older home they've been in for 20 or 30 years. Let's say for our example that it's a $200,000 house. So they have a $200,000 house and they sell it. So they get roughly $200,000 in their pocket. And that's in their pocket. Well, their kids have all moved down to another part of town. Their doctors have moved to a different part of town. Their shopping is all gone. All towns sort of go to one direction or another. And so maybe they find maybe a smaller, more manageable home, newer, in this newer part of town where all the shopping and restaurants and things are. And so they decide to buy, let's say, another $200,000 home. So to do this with a reverse mortgage, they put about 50% down, which would be $100,000. And then they don't have any payments, no more mortgage payments. Okay? So they sold this house for $200,000. They put $100,000 on this brand new house, and they have no monthly mortgage payments. So they have $100,000 left in their pocket to do what they want to with, to do what they need to do with. And then when they leave the home, either them or their heirs sell it, and they are not responsible for anything over the market value of that home. That is really a great way for our parents and our grandparents to downsize or to right size and still be convenient. I can't tell you how many times people call and say they want to be closer to their kids. They're on the wrong side of town or the older side of town, and they want to be over there where all the action is now. And so that is a very important thing to do. And they also have money left over for whatever emergencies come up. Now, some closing thoughts. I have been cautioned that this is not to be used as a last resort type thing, that it's not the answer when things are dire. You need a different answer. But it can be a very good supplemental piece to your whole financial picture. Because of the expenses, it's not beneficial if you only plan to stay a very short time in your home. But if you're planning to stay 3, 4, 5 years in your home, it may truly be a good answer for you. And most importantly, you can back out at any time. So if you want to do some research, if you want to start applying, if you want to talk to them about it, go ahead and do that. You have up until 3 days after closing to back out. It's called the right of rescission. It's in the Truth in Lending Act. But you have 3 days, up to 3 days after you close, that you can change your mind. So don't be afraid to do the research on it, to ask those questions of your lender to see what they do. And if you have any questions about it, I'll be glad to give you general information that I know. I also know some folks who do this, and it's not for everyone, but it can be a very viable option for a lot of people, especially if you have a good house with a lot of equity in it. So if you have any questions, give me a call. I will turn you over to people who know all the answers. So I'm Donna Alexander. Thanks for watching.